All right, today we're diving into Conduent's latest earnings, and it is a classic Wall Street puzzle. You've got a company that's somehow making more profit while bringing in less revenue. So how is that even possible? Well, it's all part of what we're calling their high-stakes profitability gambit. Let's get into it. And here it is, the core conflict of the quarter, laid out as clear as day. On one side, you have earnings per share, which absolutely crushed expectations. That's a huge win. But on the other side, revenue fell short of what everyone was hoping for. And this is the kind of mixed signal that really makes investors scratch their heads and ask, is this a company getting leaner and meaner, or is it a company that's just, well, shrinking? To figure that out, we've got to get past the headlines and look right under the hood. So let's dissect the key metrics that tell the real story of what happened this quarter. Okay, check this out. You can really see the split personality of this report right here. The adjusted EPS is the big surprise. Analysts were expecting a loss of 15 to 19 cents a share. Instead, Conduent delivered a 13-cent profit. That's not just a beat, that's a massive turnaround from expectations. The flip side, of course, was revenue. $754 million, a miss, but the real star of the show, that's adjusted EBITDA. Think of it as the company's core operational profit. It surged an incredible 54% from last year. This is the whole story in a nutshell. Conduent is squeezing way more profit out of less revenue. That's the gambit in action. So where did that huge profit boost come from? And where are the struggles? This breakdown tells you everything. The commercial segment, which is their biggest piece of the pie, was the real drag. Revenue was down almost 6%, mostly because a huge client is giving them less business. But just look at the contrast with government and transportation. Both saw incredible margin expansion. Government margins jumped by 520 basis points. That's a massive 5.2% increase in pure profitability. And the transportation business even managed to grow its revenue. So how on earth did the government segment pull off a margin jump like that? Well, the CFO, Giles Goodburn, laid it out pretty clearly. He said it was all about their AI and efficiency programs, which helped them slash costs on things like fraud, labor, and even phone bills. This shows you it's not just random budget cuts. They're using technology in a really targeted way to make the business fundamentally cheaper to run. And all of this, it points directly to management's playbook. They are laser-focused on a profitability-first strategy. Right now, it's not about chasing growth no matter the cost. It's about building a stronger, leaner, and much more profitable foundation for whatever comes next. And they're not just talking about it. They have a clear three-step plan. First, they're simplifying the whole company by selling off parts of the business that aren't core to their mission. Second, as we just saw, they're enforcing some serious cost discipline, using tech to push those margins higher. And third, they're sending cash back to shareholders, buying back 2.7 million of their own shares this quarter. That's a pretty strong signal that they believe in their own plan. CEO Cliff Skelton really hammered this point home on the earnings call. He basically said, look, we tell you what we're going to do, and then we go out and do it. The message from the top is crystal clear. Judge us on our execution because we are all about delivering on our promises. And you know, that confidence isn't just talk. It's baked right into their guidance for the rest of the year. So despite that revenue miss in Q2, they're sticking to their full-year revenue target. And even better, they actually raised their forecast for profitability. They're pointing to a strong sales pipeline, which is up 5% from last year, as the reason they believe they can hit these numbers. Okay, so we have the numbers, we have the strategy, but the ultimate judge is always the market, right? So how did investors actually react to this tug of war between shrinking revenue and growing profits? At first, the reaction was really positive. The stock popped over 4.5% in pre-market trading. Early on, it seemed like investors were totally focused on that huge earnings beat and the impressive margin growth. The whole profitability-first story was definitely working. But that optimism just didn't hold. As the trading day went on, the story started to shift. All those worries about the revenue miss and the weakness in their big commercial business started to creep back in. By the time the closing bell rang, the stock had given back all of its gains and then some, finishing slightly down for the day. That tells you the market is still really, really skeptical about the growth story here. That complete reversal on earnings day perfectly sets up the big question. Where does the stock go from here? So let's weigh the bull case against the bear case for Conduent. After a quarter that was a beat and a miss at the same time, the path forward is anything but clear. So if you're an investor looking at Conduent right now, what's the move? How do you play this? It really all boils down to two competing stories. The bull case is basically a bet on management. You're betting their turnaround plan is the real deal, that this cost discipline will keep boosting margins, and that all their financial maneuvering will eventually unlock a ton of value. The bear case, on the other hand, is a bet against the top line. You believe the revenue problem isn't going away, that the market's going to run out of patience, and that the crucial commercial segment just isn't going to bounce back.
So, our call is this. We think the stock is going to be stuck in a trading range for the near future. The market definitely sees and likes the profit improvements, but it's officially in show-me mode when it comes to revenue. Until Conduent can show some hard proof that their sales have stopped shrinking and are starting to stabilize, it's really hard to see a major catalyst that could push the stock significantly higher. And all of that brings us to our final rating, market perform. We expect Conduent stock to basically trade in line with the broader market for now. The better profits and the share buybacks should act as a safety net, but the upside feels capped by those big questions about growth. The real multi-billion-dollar question is this. Is this a company building a strong foundation for future growth, or is it just getting really good at managing a slow decline? And as always, just a reminder that this analysis is for informational purposes only. It is not financial advice.